Now, many of you have seen my videos where I talk about term and whole life, but today I want to talk about indexed universal life. And this is something that I haven't talked about on any of my videos. Imagine having a life insurance policy that not only protects your family when you're gone, but also builds a cash reserve you can use while you're alive. Now, what if that policy gave you growth potential linked to the stock market without risking all your money if the market crashed? That's where Indexed Universal Life comes in, also called an IUL. But here's the twist. An IUL isn't perfect for everyone. It has unique benefits, but also limitations that you need to understand before deciding if it's the right fit. So today, let's break down what an IUL really is, how it works, and whether it could play a role in your financial strategy. So let's get started. Here's a simple version. When the index goes up, your cash value earns interest based on that performance up to a certain cap rate. When the index goes down, you don't lose cash value due to market decline. You are protected by a floor, usually 0 or 1%. So for example, let's say your IUL has a cap of 12%. If the index returns 15% in a given year, you'll only receive 12% credit to your cash value. Now on the flip side, if the market drops 20%, your cash value won't lose value due to that decline. It just earns 0% for that period. That means your cash value can grow in good years, and in bad years, the worst your growth will ever be is none. Now, on top of that, IULs are flexible. You can adjust your premiums and even change the death benefit within certain limits. That flexibility is one reason many people use them for long-term financial planning. Now, what are the key features of an IUL, and how does it differ from whole life? Here are the big features you should know about. First of all, is tax-deferred growth. Your cash value grows without immediate taxes. Tax-free loans. You can borrow against the cash value without triggering taxes as long as the policy stays in force. Lifelong coverage. As long as you fund it properly, the policy won't expire. Has upside potential and downside protection. Growth linked to the index, but protection against market loss. Now here how it differs from whole life. Whole life offers a fixed interest rate, often around 3 to 5%, that grows steadily and predictably. It's more conservative, but it's also less flexible. With an IUL, you can trade guaranteed steady growth for the potential to earn more tied to an index while still having a safety floor. Now, why does an IUL work for some people? And here's how it works. Families who want both life insurance protection and a way to accumulate savings. Business owners looking for tax advantage ways to grow and access capital. People who want to supplement retirement income without relying on their 401k, parents or grandparents who want to build a legacy while having financial flexibility. So it may not work for others. Now, let's be clear. It's not a one-size-fits-all product. Premiums can be higher than term insurance. If you're only looking for cheap coverage, an IUL is not your best choice. The policy depends on consistent funding. If you're underfunded, the policy collapses. Returns are limited. You won't capture the full upside of the market because of those cap rates. And it has a long-term strategy. If you're looking for quick returns, this isn't it. Now, let me give you a real-life story. A client of mine named David was in his late 40s, successful in his career, and wanted more than just a death benefit. He was looking for a way to grow money for retirement while protecting his family. I set him up with an IUL. Over the years, his cash value grew steadily. He didn't get rich overnight, but the account avoided losses during market downturn. Now let's fast forward to his daughter's college years. He borrowed the money from the cash value to help pay her tuition. Later years, he used the same policy to supplement his retirement income. Dave told me, Jay, this policy gives me flexibility. It wasn't about leaving something behind. It was about living with peace of mind. Now, let's give you a quick snapshot. Term versus whole life versus IUL. Term life, lowest cost, temporary coverage, 10 to 30 years, but no cash value. Whole life, permanent coverage, steady guaranteed growth, fixed premiums, conservative but reliable. Indexed Universal Life, IULs. Permanent coverage, flexible premium, market-linked growth with caps and floors, greater long-term potential, but requires discipline. Now, Indexed Universal Life can be a smart tool, but only if it fits your goals, budget, and financial plan. The key is understanding both the strength and the trade-offs before making a move. So if you want to explore more of how a IUL makes sense for your situation, let's talk. Now, if you like this video, please share it with someone thinking about life insurance and subscribe for more financial insights. But don't stop here. Check out my next video right here and other videos on my life insurance section on my YouTube channel. And as I like to say, call Jay today. Thanks for listening.